Well, hello, everyone. This is Betty Meredith, president of the Retirement Resource Center, a retirement education and training company for financial professionals, their clients, and consumers. We're happy to be here with you for this presentation on how to use reverse mortgages to secure retirement with Wade Pfau, PhD, as our presenter today. And I know he's truly looking forward to being with you today and sharing his thoughts and insights. So we'll go through some housekeeping items first while people are still signing in. I'd like to call your attention to the participant control panel at the right side of your screen. And if you have trouble now or during the session with the audio or visual portions of the presentation, please feel free to ask us for help by clicking on the raise hand icon or typing a message into the question chat box at the bottom portion of your panel. And please feel free to submit questions during the presentations as they occur to you, and we'll address them at the end of the presentation so we can keep the session length to an hour. And please download or print the handout for today's session for taking notes. You can click on the sideways triangle in the participant control panel where it says handouts, and they're available in either 2 or 3 slides to a page, so you can choose the format you prefer. And you may earn CFP and other retirement professional CE credit for your attendance in this webinar today. So if you haven't done so yet, when you registered for the course, please feel free to enter your CFP number in the chat now, and that'll link to your name. And you'll receive an email with a certificate of proof of earning 1 CE credit as long as you're on the webinar for at least 50 minutes. And please give the CFP board up to a week for the credit to be reflected in your CE records as we report directly to them on your behalf. You'll need to self-report for all their professional certifications, CE, College for Financial Planning, and CLPF credit. So before I formally introduce the topic and Wade, I'm going to turn it over to Shelley Giordano from Mutual of Omaha Mortgage, which is sponsoring this presentation. Shelley?
Yeah, thank you. Thank you, Betty, for collaborating with us today with such timely content for our referral partners. Of course, we're absolutely thrilled and honored to sponsor Dr. Wade Pfau. We've worked with Dr. Pfau for about a decade when we first served on the Funding Longevity Task Force. And of course, in that period of time, he's become the preeminent authority on using housing wealth to help secure retirement. So delighted to be part of this. And also just wanted to thank our attendees. We've got a lot to learn today, and I think some of it might be surprising to some of you. So, so let's go.
All right. Thank you, Shelley, and thank you, Mutual of Omaha Mortgage, for sponsoring this presentation. So how can a reverse mortgage be used to better secure retirement? And in the early days, reverse mortgages were generally treated as the last resort option after other resources were depleted, or as a way to obtain quick access to large lump sum of assets. This is not the appropriate way to think about reverse mortgages in a retirement income plan, especially in the light of recent research. The reverse mortgage option should be viewed as a method for responsible retirees to create liquidity for an otherwise illiquid asset, which in turn can create new options that potentially support a more efficient retirement income strategy, such as more spending and or a greater legacy. So financial advisors must pay attention to their clients' home equity, as this is a vital asset that can be used as part of a coordinated strategy to improve retirement outcomes. Wade Pfau is the founder of Retirement Researcher and educational research for individuals and financial advisors on the topics related to retirement income planning. He is also co-founder of the Retirement Income Style Awareness Tool and a co-host of the Retirement Risk Style podcast. He serves as a principal and director of retirement research at McLean Asset Management and as a research fellow for the Alliance for Lifetime Income and Retirement Income Institute, and is still a professor of practice at the American College of Financial Services. He is also past director of the RICP designation program. He holds a doctorate from Princeton and has published more than 60 peer-reviewed articles in a wide variety of academic and practitioner journals. And he is the author of 3 books in the Retirement Researchers series, and one of them is one on retirement mortgage, reverse mortgages, which you can see on the screen here. So we encourage you to check that out. So Wade, thanks for being here with us today. I'll now turn it over to you.
Okay, thank you, Betty. Thanks everyone for joining in, and thank you, Shelley, for the introduction as well. Indeed, with my role at the American College, my title at the time was Professor of Retirement Income. So I really felt a responsibility to make sure I cover all aspects of retirement. I hadn't really paid a lot of attention to reverse mortgages. I knew it was something I should look at. But indeed, with the organization that Shelley developed, the Funding Longevity Task Force, they invited me to a meeting in 2014. And John Salter, who's a professor at Texas Tech and one of the researchers whose work I'll be mentioning today, he sent me a stack of articles about reverse mortgages. So on the flight to that meeting, I was reading the articles and I was hooked. I've built a career around writing computer programs to simulate different retirement strategies. And there's so many interesting aspects of how a reverse mortgage works that I was hooked on the idea of looking deeper into replicating the past research and doing my own research as well on what sort of role reverse mortgages can play in retirement income. Now, at that time, I was trying to write a book on retirement planning. And ultimately, that book was finished in 2021. The chapter on housing wealth got so long that it became its own independent book. And so the first book I wrote, going back to 2016, was the book on reverse mortgages. If you just want a chapter summary of the reverse mortgages book, the retirement planning guidebook would be another option as well. Now, that being said, what we're going to be looking at today, I'll talk a little bit about how reverse mortgages work, and then really talk about them in the context of retirement income, how they can be used as a risk management and really as a risk mitigation strategy for retirees. And then look at the mechanisms whereby reverse mortgages can coordinate to help manage retirement spending overall, including from investments, from other assets, to most effectively and efficiently meet retirement goals. So a little bit of context to understand better why reverse mortgages can contribute positively to outcomes. And retirement's different from pre-retirement. I think so much of the mindset of looking at financial planning is from an accumulation framework or an accumulation mindset, where if you use this analogy of mountain climbing, the idea with accumulation is climbing the mountain. So if you ask, what's the goal of mountain climbing? Usually the answer would be to get to the top of the mountain. But the reality is you have to safely get back down the mountain as well, or you haven't had a successful expedition. And most mountain climbing accidents happen on the way down, not on the way up. And with retirement planning, there's a similar idea where in the accumulation phase of life, we're trying to accumulation assets. Often the goal of retirement planning becomes meeting some wealth target. If I could save this number, I can retire. But really, that's just the beginning. Retirement income is really about sustaining lifestyle over an unknown time horizon. Once you can no longer rely on work to support the income, you have to distribute from your asset base to support spending needs over an unknown time horizon. And in the face of that, we'll talk about the sequence of returns risk, the longevity risk, and different spending shocks as well, where there may be surprises to the budget where retirees have to spend more than anticipated. We really have to think, what's an efficient way to get down the mountain? And that's where tools like reverse mortgages, which when you look at them in isolation, it's easy to say they may look expensive. But when you look at them within the context of a coordinated strategy to efficiently meet retirement goals, expenses are not as important as, well, how much money do you have how much do you have left at the end of retirement? And we'll look in detail about how efficient coordinated retirement income strategies can better meet retirement spending goals and support larger net legacies at the end of retirement. And if you get a larger legacy from a given pot of assets, the idea of a fee drag doesn't matter there. It's less expensive if you're able to have more assets at the end. And so that's what we want to look at. And so again, this idea of retirement being different, longevity risk is the overarching risk of retirement. It's the idea people don't know how long they're going to live. It's misnamed because, of course, it's wonderful to live a long time. It's just on the financial side. The longer someone lives, the more expensive their retirement is. So the cost of retirement grows with the length of retirement. And the risk is that you eventually outlive the asset base that you had saved for retirement. And then with those longer retirements, there's just time for these other risks to more easily become an issue. Macroeconomic and market-related risks, inflation eating away at the purchasing power of wealth, and then different personal spending shocks as well. So this is how I think about building retirement income plans, where the goals of the 4 L's on the left, longevity, lifestyle, legacy, and liquidity, and they map into liabilities or the expenses associated with these goals on the right. So longevity is about essential spending, lifestyle is about the discretionary spending on top of that to enjoy the best possible lifestyle in retirement. Legacy, didn't think of another name for it, but it's what you want to leave to the next generation. And then liquidity is about having assets available to support contingencies, spending shocks, situations where your retirement budget is your essential and discretionary expenses. But what happens if you have to spend more than that? either due to an unanticipated health event, a long-term care need, helping a family member, things that weren't necessarily part of the budget. And then retirement income is really about positioning assets to matched up against these goals or liabilities. So reliable income, having safe, secure income sources, you match up against essentials. The diversified investment portfolio, you match up against discretionary expenses, legacy goals, and if you're more investment oriented, maybe essentials as well. And then reserve assets that haven't been earmarked for other purposes, or what's available for contingencies. I show this because this is really the starting point to start thinking about housing wealth. I think it's still the case that the default for housing wealth is people throw it in the reserves bucket and don't give a lot of other thought to it. They're going to have the house, it's there, and if they ever get into a situation where things go bad in retirement, spending shocks, or they've depleted their investments, or they just run out of other options, then they'll consider how to use housing wealth as part of the retirement income plan late in retirement when they've run out of other options, that it's that last resort that will be used to meet retirement expenses if everything else goes wrong. Now, that being said, that might be when they think about a reverse mortgage. They could potentially sell the house at that point and rent, or at that point use a reverse mortgage to help meet their retirement expenses. Now, that last resort strategy, that conventional wisdom, that idea that you leave the house alone, you don't touch it, and you just save it for emergencies, and then otherwise, if there is no emergency, the house becomes part of the legacy to the next generation. It gets funneled into the legacy category. What the research has consistently shown in this area, and that's the articles I was reading on that plane flight in 2014, that's really the least efficient way to use housing wealth as part of a retirement income plan. And that's how we'll talk about other ways. So you can treat housing wealth as part of reliable income. The home equity conversion mortgage or reverse mortgage with a 10-year payment. That 10-year payment option, it's one of the spending options, provides an ongoing monthly income. And it continues even if you've exhausted the entire borrowing capacity from the reverse mortgage. So in that way, it acts like an annuity. It does need an asterisk about lifetime income. As long as you're eligible for the loan, even if you've used up the entire borrowing base, you continue to receive those monthly payments. But if you move out of the home, the payments would stop. But if you have a 10-year payment, you can treat that as a reliable income asset, reducing distribution pressures on investments. Or you could treat it as a coordinated strategy with the diversified portfolio where, and I'll talk more about this, but the basic idea is if markets are doing well, I'll spend from my investments. If markets are doing poorly and I need a distribution, I'll take that distribution from the growing line of credit on a home equity conversion mortgage. And then you could also still treat it as a reserve, but I'll also be talking about in the presentation. If I open the reverse mortgage sooner rather than later, now you do have to be at least 62 to be a borrower, but opening it sooner and letting that line of credit grow, the odds are really in your favor that you're going to have much more borrowing capacity later in retirement. And so rather than treating it as a last resort, but opening the reverse mortgage earlier in retirement, letting that line of credit grow, and then using it for all types of different possibilities, we'll talk about how that's a more efficient way to approach incorporating housing wealth into a retirement income plan. So here's a list of potential uses for reverse mortgages. And in the reverse mortgage book, I do have examples for all these. We won't be able to get into examples for all of them in the presentation today, but let me give you a brief overview here. So there's 4 broad potential categories. The first we'll call portfolio coordination for retirement spending. This is where a lot of the research has been focused, going back to the first articles published in 2012 in the Journal of Financial Planning. How do you coordinate between the reverse mortgage and the investment portfolio? Well, the last resort conventional wisdom strategy would be an option there. It's going to be the least efficient option, but it's I'll spend from my investments. If they run out, I'll open a reverse mortgage and spend from it. Other options, I'll open the reverse mortgage early on and turn on the 10-year payment, giving me that monthly distribution, reducing what I need to take out of my investments, helping to mitigate risk for my investments, and going from there. Or I could use a coordinated strategy where I'll spend from the reverse mortgage when my investments look to be in trouble to try to give them more opportunity to recover. Another category is coordinating between the investment portfolio and housing, the reverse mortgage. for housing debt in retirement. Now, the most popular use of a reverse mortgage is more and more Americans are carrying traditional mortgages into retirement. That increases risk for their retirement income plan, because if I have this large fixed payment in early retirement, even if that payment goes away eventually because I've paid off the mortgage, that will increase sequence of returns risk. I have to take a larger distribution early in retirement, and if the market goes down, that leads to a decline in the value of my portfolio, forcing me to spend an increasing percentage of what's left. And so carrying a mortgage into retirement can be risky. Well, a reverse mortgage could simply be used to refinance the existing mortgage and move those large fixed mortgage payments from the early retirement years to, they become voluntary until, well, of course, due at some point, but at least until much later in retirement when the loan balance may become due. And so that reduces pressure on the investments, which, if this strategy is more efficient, will ultimately allow the investments to grow to pay off the loan balance later in retirement when you're not exposed to that sequence of returns risk, and still have a windfall of larger remaining assets after that loan balance has been repaid. There's also interesting strategies around purchasing a new home with the HECM for purchase, where the reverse mortgage is used as part of the new home purchase. Another interesting example here is people like staying in their homes, and that may require doing home renovations to support aging in place. Well, a reverse mortgage may pay for those home renovations, such as building a wheelchair accessible entrance, or creating an elevator in the home, or installing a bathroom on the first floor. Just different things where the retirees would like to stay in their home, but they may not really be able to unless they can do some renovations. Again, the reverse mortgage could pay for those. Now, a third category here is funding source for retirement efficiency improvements. So much of retirement income planning is about making a short-term sacrifice for a long-term gain. Well, a reverse mortgage could pay for some of those short-term sacrifices, whether that's, we all know that at least for the high earner couple, there's a lot of value in delaying Social Security benefits. If somebody's already retired, they need to cover the expenses in the meantime. And so using a term payment from a reverse mortgage to provide those payments until Social Security begins could be an opportunity. There can be value with Roth conversions in retirement, where you voluntarily pay taxes early on to create better financial planning opportunities over the retirement. A reverse mortgage could pay the tax bill on a Roth conversion. Also, annuities, paying that lump sum premium for an ongoing monthly income for the rest of your life can create a lot of efficiency. Well, you might look at the 10-year payment of a reverse mortgage as an alternative to using an annuity. And another issue is a lot of Americans, they lapse on their long-term care insurance policies because premium increases that take place. Well, a reverse mortgage could be a way to make sure you continue paying the premiums on existing policy and not lapsing on it in those later years when you may be getting to the point where you really would be able to take advantage of that policy if it's kept in force. And then the final category is to preserve credit as an insurance policy. And the idea here will be, and I'll talk more about the mechanics of the growing line of credit, but you open a reverse mortgage, you allow that line of credit to begin to grow, and then you have a large pool of potential funds to be used to pay for expenses in retirement, whether that's supporting spending if your investments deplete, whether that's providing a contingency fund for different spending shocks to pay for in-home care, pay for large health bills. There's some interesting uses as part of a divorce settlement to help split up the home equity of the marital home. And then also there's some interesting aspects around when you open a reverse mortgage, the line of credit grows independently from the subsequent value of the home. And so as a protective hedge on the value of the home, it's been possible if the home, especially if the home value stagnates in retirement or declines, that eventually the borrowing capacity of the reverse mortgage could exceed the value of the home. And because it's a non-recourse loan, this could create an opportunity for individuals to tap into that line of credit to receive a windfall distribution when it's worth more than their home. And so you can see that would protect the value of their home. It's like a put option on the value of the home. And so that's another potential use. Okay, so getting more into this, retirees face longevity and market volatility risk. And when we talk about distributions from investments, there's really only 4 ways to manage that type of risk. The first, you spend less. Well, the reverse mortgage is not about spending less overall, but spending less from your investments because you're tapping a portion of the spending from the reverse mortgage to help reduce distribution pressures on your investments, whether that's the 10-year payment, whether that's refinancing the mortgage to take those fixed payments, mortgage payments out of the early retirement years, whether that's a Social Security delay bridge, all ways to reduce distribution pressure on investments. And delaying Social Security over the long term is a huge reduction in distribution pressure on investments. Other options, spend flexibly. If I can cut my spending after a market downturn, that can help manage this risk. Well, with the reverse mortgage, you don't have to cut spending after the market downturn, so there's no particular use case there. The same with managing volatility can become important. But then the fourth approach, where there is another use case for the reverse mortgage, the idea of buffer assets. So having an asset outside the investment portfolio that's not correlated with the portfolio, which just means if the markets are down, the buffer asset does not decline in value. You can temporarily then cover spending through the buffer asset to avoid having to take distributions from the investments and give those investments a better opportunity to recover. And so that's another interesting use case of the reverse mortgage. And for buffer assets, there's really only three. The original one was you have a big pile of cash on the sidelines, which can create a lot of drag in terms of potential returns on the cash. You could have the cash value of a whole life insurance policy. There's a similar conversation there, using it as a buffer asset. And then there's the reverse mortgage, home equity conversion mortgage, growing line of credit, which is the third buffer asset that I'm comfortable naming as something that can be used for this purpose, because it needs to be liquid, it needs to be available. Can't be frozen. A HELOC doesn't work for this because HELOCs get frozen or canceled during times of market volatility, and so then they don't work as a buffer asset. But a reverse mortgage provides that contractual protection that you'll have access to those funds and can use it to support spending and to let the investment portfolio recover during downturns. Now, these next two slides are meant to provide intuition for what you're going to see later in the presentation. There's no reverse mortgage on these next two slides, but we're going to set up the story for how the reverse mortgage could potentially add value. And so this first slide, this presentation is based on Robert Shiller historical data that goes with housing, at least back to 1890. And we're going to look at different rolling historical periods. I pulled out the period from 1962 to 1995 as a useful example. It's not the worst case in history, but it's also, it's on the worst side of cases in history. And to just see how the reverse mortgage or investments behave during different historical periods. So if I had a 60-40 portfolio from 1962 to 1995, this is a 34-year long retirement. If you're familiar with the 4% rule, that was calibrated specifically to 30 years. This is 34 years, but if I used a 3.95% withdrawal rate, which means I took $39,500 from $1 million in year one in 1962, and I increased that spending for inflation every year, I would run out of money in 1995. Now, if I could just reduce that distribution rate slightly, say to 3.75%, 20 basis point reduction, then I still have $1 million left in 1995. Now, that's not inflation adjusted. It would mean $1 million in 1960. I still have $1 million in 1995. By reducing the distribution rate from 3.95% to 3.75%. If I reduced it to 3.55%, I've got $2 million left at the end of 1995. Now, the idea here is, think about the 10-year payment is going to provide monthly income from the reverse mortgage for as long as you remain eligible for the loan. So if I can offset my distribution from investments by tapping part of my spending needs from the reverse mortgage, the idea here is that creates synergies. That has a big impact on the sustainability of those investments. And so then, as long as I can pay off the loan balance for less than these increases to my investments, I can do so and still leave a larger legacy at the end of retirement. Now, another possible example, we're back to spending 3.95% as an initial distribution rate. Your $1 million in 1962 drops to zero in 1995. Now, what if I could skip one distribution over that period of 34 years? And it's not random, but there were big downturns in 1969, 1973, 1974. What if I skipped the distribution in a year after a market downturn? So I take 33 of the 34 distributions, but I skip one. Well, we can see that's the biggest downturn was in 1974. So in 1975, if I skip that distribution, I have more than $800,000 left at the end of 1995. With the other two examples, it's in the ballpark of $700,000 left. What if I could have skipped all three of those distributions? Then I still have $2.25 million left at the end of 1995. Now, the idea then with the reverse mortgage is not that I would skip spending for an entire year, but that's the buffer asset idea. If I could tap into the reverse mortgage to cover spending for that year, and because it doesn't go into my adjusted gross income, it's proceeds from a loan, so I don't have to worry about paying taxes on that either. May not have to take as big a distribution with less taxes. That could be a way to cover that distribution need, leave the portfolio alone, let the portfolio recover. And so we're back to the situation that, again, this slide doesn't answer the question, but that's what the later analysis is going to be looking at. Say I tapped into the reverse mortgage to cover those, well, the reverse mortgage didn't exist at the time, but just looking at historical data and applying today's system to the past, if I could have tapped into a reverse mortgage in those 3 years after a market downturn, as long as the loan balance on the initial setup costs and those 3 years of distributions plus interest does not exceed $2.25 million, then I can pay off that loan balance and I'll have something left over. And so I can meet my spending that way and provide a larger net legacy at the end of retirement. Well, if that happens, and that's what we're going to look at, then the reverse mortgage has provided a better financial planning outcome. Okay, so that's some background. Now we're going to start digging into this. And given time constraints, I'm not going to spend much time on how reverse mortgages work. This is something covered early on in the chapter of my reverse mortgage book, as well as the retirement planning guide book. And also, I think most folks here may have been invited by your contact reverse mortgage lender at Mutual of Omaha. You can also get these details from anyone who's working in the reverse mortgage space. That the basic requirements of using a HECM has to be a primary residence. You have to be 62 or older. You can refinance existing mortgages, but you can't carry a traditional mortgage and have a reverse mortgage at the same time. You have to have resources to pay your homeowner's obligations. There's a counseling session that borrowers need to complete. And also it needs to be an FHA eligible property with an FHA home appraisal. And the lending limit in 2025 is $1.2 million. And that's not how much you can borrow from the reverse mortgage, but the principal limit factor that determines the borrowing capacity will be applied on the value of the home up to that level. The home could be worth more than that, but the reverse mortgage would only be applied to up to that number, not more. Now there's some other terms, but again, due to time constraints, because we've got a lot to get through, I'm not going to spend much time explaining this aspect of reverse mortgages, but the basic idea is the principal limit is the borrowing capacity of the reverse mortgage. The principal limit factor is a percentage of the home value up to that lending limit that the principal limit will be defined from. The expected rate is an interest rate used to determine the initial borrowing capacity, and the effective rate. Now there are two different types of HECMs. There's a variable rate HECM and a fixed rate HECM. With the data I've seen, the use of fixed rate HECMs is well under 1% at this point. They don't have a line of credit. So when I talk about a line of credit, that is for a variable rate HECM, and then the effective rate is a variable interest rate that shows how the principal limit will increase over time with a variable rate HECM. Yeah, let me skip this slide for now. So let's talk a little bit about the idea of a growing line of credit. So the principal limit of a reverse mortgage, it consists of 3 possible categories, and we'll simplify it even further by assuming there's no set-asides. But the set-asides can be to help cover homeowner obligations if they don't have other resources. Let's ignore the set-asides. They have plenty of financial resources. The principal limit is loan balance plus line of credit. And that equation is always true. Now, the effective rate will tell you how the principal limit grows. And that pie is all going to grow. If I'm not changing the composition, if I'm not taking from the line of credit, or I'm not making a voluntary repayment back into the line of credit, the composition of the pie stays the same. If half of the principal limit is loan balance, half is line of credit, each of those halves grows at the same variable interest rate. The whole principal limit is growing at that same variable interest rate. And I have flexibility. If I borrow from the line of credit, I move it into the loan balance. So I change the composition of the pie, but then it's all subsequently growing at the same variable rate. If I make a voluntary repayment, I reduce the loan balance and return that to the available line of credit. I change the composition of the pie, and then it all subsequently grows at the same variable interest rate. Now, this is where, when you hear about there's a growing line of credit, I think the initial thought is, well, that sounds too good to be true. So why does it exist? I think it's just an issue. This program was designed by policymakers. It goes back to 1989 was the initial HECM program. I think policymakers assumed people would use these because they want to borrow funds. And so the principal limit would be loan balance. And we can understand why the loan balance would grow over time. Well, then financial planners caught on to the idea that actually there's a trick you can use with these. You do have to keep a minimal loan balance to keep it open, maybe $50 to $100, but the rest can just be kept as a line of credit. And that line of credit is then growing at the same rate that the loan balance would be growing. It's that same effective rate applied to the principal limit. And so you can open this up and its line of credit's growing at the same rate that the loan balance would be growing. And that can create some real opportunities over a longer retirement. And that's the idea of the growing line of credit. They have different spending options. You could take out a lump sum. You could turn on the 10-year payment, which is ongoing for potentially as long as you live, as long as you're eligible for the loan. Term payment for a fixed number of years, and then the line of credit that you can spend from in an ad hoc manner. Now, I do have a reverse mortgage calculator on my website if you'd like to play around with it. It's very easy to use in that regard, and there's a link to it in the chat, where this is not going to show you how the line of credit grows over time, but it would let you put in all the details needed to see, like, what could a client potentially borrow based on the home value, the different interest rates going into the loan, the origination fees, whether they're going to finance those upfront costs as part of the loan. And then it's going to tell you the net available borrowing capacity, and it will also show you the 10-year payment you could get from it. And you can see just in the example that it defaults to, which is on the screen here, for a $430,000 home, the 10-year payment, and just with these numbers, added up to more than $10,000 a year. And then also, if the term payment you see for 8 years, that would be like a Social Security delay bridge from 62 to 70, that would give you annual distributions of $28,700 on this home with these particular parameters. But you can use that to get a sense of what is available, and this allows you to include the full upfront costs. In this particular example, upfront costs were $17,100. Now, the biggest component of that is the initial mortgage insurance premium, which is 2% of the home value up to the lending limit. That can create some sticker shock, but all the analysis is done assuming those types of costs. And there's a lot of insurance value provided by these insurance premiums. Guaranteed access to the borrowing, having that non-recourse aspect in place where the mortgage insurance fund will make the lender whole if the loan balance exceeds the value of the home. And just having that guaranteed access to the funds, it's all important aspects to consider with the reverse mortgage. I've heard it said by different lenders that it's not too good to be true, but it's too good to be free. And that's where these costs factor into it. Okay, getting into a case study to then see whether that intuition I was talking about earlier on applies. This is based on current HECM rules, current tax laws. So it's 2025. I am going to draw on historical data going back to 1890. But that's just to get a variety of market scenarios. We're not going back in history and applying the tax laws or the HECM rules, because like I mentioned, HECMs did not exist until 1989. So if we go back to 1900, it's not that we're actually taking out a reverse mortgage in 1900. We're using today's rules, but then we're just going to look at how different strategies would perform based on different historical market environments. So that's the role of the historical data, to give us different scenarios based on today's HECM rules and HECM laws. We'll look at this for a couple who both turned 62 at the start of 2025. They want to build a plan that is sustainable through age 95. They have $900,000 of investment assets, and you can see the details there, how it's split between a taxable account, an IRA, and a Roth IRA. They have a $450,000 home, which is, as you know, half of the investment balance. The larger the value of the home relative to the investments, the more potential of value there is to the end user in incorporating the home equity into their plan to help manage the distributions from their investments. So in this particular case study, the investments are worth twice as much as the home. Again, if their investments were only $450,000, we'd see bigger relative impacts from the reverse mortgage. Now, with the HECM that we're looking, and there's no existing mortgage. They fully paid off their mortgage in this case study. The HECM has a 2.5% lender's margin as part of the loan, $19,000 of upfront costs that they'll finance into the loan, and we'll use the 1-year treasury for effective rate, for determining the effective rate. They do also have Social Security, and in my book, we're just building a simple case study here. We'll change all these details in different case studies, like delaying Social Security and so forth. But in the simple baseline case study, they're going to delay to the full retirement age, and that will give them $45,000 annually plus inflation. Now, their spending goals, they want to spend $67,000 a year before inflation adjusted, before tax. During the go-go years in their 60s and up to 74, they want to have an extra spending amount on top of that, and then they do have to pay federal income taxes on top of that. What they're going to spend each year, any Social Security once it starts, any HECM distribution coming their way, which would be relevant if they turn on the 10-year payment, and any RMDs from their IRA. Then, if that's more than they need to spend, they'll reinvest a surplus in their taxable account. If that's less than they need for spending, then they'll use the conventional wisdom retirement spending strategy, which, again, you can do better than that with Roth conversions of things. But for this simple case study, they'll spend from the taxable account, then the IRA, and then the Roth IRA. I will track their taxes in detail. They do live in a state with no state income tax, but at the federal level, we're looking at taxes on ordinary income, taxes on long-term capital gains. We'll calculate taxes on their Social Security benefits. Now, this particular household isn't wealthy enough and doesn't have a big enough spending goal to worry about the Medicare IRMAA surcharges or the net investment income tax, but I am also tracking those. It's just in this case study, they don't have to pay higher Medicare premiums or the net investment income surtax. Their asset allocation is 60-40, and at the end of the retirement, any leftover assets, the legacy will be defined as 100% of the taxable account because of the step up in basis, 75% of the IRA because of the embedded income tax liability, and I'll assume it goes to their adult children who will be in the 25% tax bracket during the 10-year window when they take those distributions. 100% of the Roth IRA, it does also have a 10-year distribution period, but it's not taxed to the beneficiaries. And then 95% of the home value, if they have a HECM, less the loan balance due on the HECM, but not less than zero because the HECM is non-recourse. So if the loan balance exceeds the line, or the loan balance exceeds the home value, then those just net out to zero. It's based on Robert Shiller's historical data going back to 1890. And let's just look at different aspects of that. The first is this idea of the growing line of credit. So what's the probability that I'll have more borrowing capacity if I open at 62 and let the line of credit grow versus I wait to a later age? Now, if I wait to open the reverse mortgage, I should get more borrowing capacity. That's more time for the house value to grow. And also, I'm older, so the borrowing percentage is higher. It increases with age. However, if I open at 62, I benefit from that growing line of credit. And so what we see here is if I open it at 62, depending on what age, there's anywhere from like a 65 to 75% chance that my borrowing capacity will be bigger in the future than if I waited until the future to open it. And this brings up another interesting point as well, because you can refinance. Like if I'm in that 25 to 35% of the time where it would have paid off to wait, Well, I just refinance at that point and get access to that higher borrowing capacity. That's what was going on during the pandemic. House prices were shooting up, interest rates got extremely low. That created the scenarios where you could have got more money by waiting. Well, you simply refinance. You can't go back historically and open it up earlier because you would have been better off. But if you open it up earlier, you can refinance if you would have been better off. But again, the odds are 65 to 75% of the time, you're going to have more borrowing capacity by opening it earlier than by waiting. Now here's just an example of that 1962 case that I like to use sometimes when pulling out an individual year. The home value was $450,000 in 1962. We can see how the home value appreciates. By 1995, it's worth about $2.4 million. And I'm using the Case-Shiller Housing Price Index to track that. Now we look at that cyan curve is I open the line of credit in 1962 and let it grow. The yellow curve is I wait to open the reverse mortgage, and it adjusts based on changing interest rates, based on the changing age, and based on the changing home value. Well, the yellow curve does go up over time, but this is one of those 65 to 75% of the time scenarios where borrowing capacity is a lot bigger by opening it at the beginning and letting it grow rather than letting it wait. You see that difference is in 1985, if they opened a line of credit in 1962, they've got $1.1 million of borrowing capacity versus if they waited until 1985 to open it, they'd only have about $400,000 of borrowing capacity. And you can also see this idea of the non-recourse aspect. By about 1992, the line of credit actually exceeds the value of the home. So if they just left it alone for all those years, by 1995, if they're still alive and everything, they could tap into that and get, we're looking at maybe about $2.8 million. But all they would owe at the end of retirement is, say, that $2.3 to $2.4 million. The rest would be a surplus. And the mortgage insurance premiums that they paid would have supported that. Okay, so we will look at a case for the portfolio coordination because that's the most famous example. And then other cases are, I go into detail in the reverse mortgage book if you want to dive into this with other examples as well. But this is where most of the research is focused. In fact, in 2012, there were 2 different articles published in the Journal of Financial Planning. They didn't know about each other's work, but they both, the thesis of the articles was quite similar. They took a different approach to looking at it, got slightly different results, but very much aligned with each other. Strategic use of a reverse mortgage standby line of credit can create retirement income efficiencies through its contribution in managing sequence of returns risk in retirement. And that was Barry Sachs and his brother Stephen, first published in February 2012. And then John Salter, Sean Pfeiffer, and Harold Vinsky published their iteration of that research in August of 2012. And it points to the answer to that intuition we were talking about earlier, where by reducing pressure on investments, you allow those investments to grow, and more often than not, that would offset the costs of the reverse mortgage that was used to cover spending to reduce the pressure on the investments. So you pay off the loan balance and you have more left over at the end. Now I'll show a case study, which is just my iteration of replicating their research, the same kind of goal of their research, slightly different approach, but I'll look at 10-year payments. We'll turn on a 10-year payment. And then also looking at a portfolio coordination strategy where I strategically spend from investments sometimes and from the reverse mortgage sometimes. And I'll explain my rule for that. And we'll compare those to using home equity as the last resort, which is I don't touch the reverse mortgage until I run out of investments. Then I open it and try to cover my spending subsequently. The decision rule I'll use for this, it's a simple rule. I just looked at a bunch of different rules. This one's simple. It's more aligned in spirit to the Salter, Ivinsky, Pfeiffer work. But theirs was more complicated. You have to build an entire glide path of how much money you need every year, and you track whether you have more or less than that left to determine when you spend from the reverse mortgage. This is just a simple version of what they created, but I find it seems to work just as well, and that's you write down the value of the investment balance at retirement. So in this case study, they had $900,000 at the start of retirement. You just tuck that number away. You don't even have to worry about increasing it for inflation. In the future, when you want to take a distribution to meet expenses, you look, if the value of the investments exceeds $900,000, you spend from the investments. If the value of investments is less than $900,000 and you still have borrowing capacity within the HECM, you spend from the HECM. And you just use that rule throughout retirement. So that would be that's the portfolio coordination strategy I'm looking at. Now, this is the last resort strategy. So this is, I picked their spending goal to be conservative so that they don't run out of money very often. Actually, with the conventional wisdom, they have a 95% chance for success. In these rolling historical periods, different 34-year periods going back to 1890, this is how much money is left at the end of retirement if they used a last resort strategy. Now, if there's a dot on the point, the dots reflect their investments ran out, and so they had to tap into the reverse mortgage. So they opened the reverse mortgage when their investments run out from retirement years starting when there's a dot there. Now, if the dotted points are above zero, the last resort strategy survived. They were able to fully meet their spending goal and leave a little bit something at the end of retirement. Now in the 1960s and early 70s, you see 5 points where the dots are below zero. Those would be failure points. So that's, they run out of investments, then they open the reverse mortgage, and then they spend all they could from the reverse mortgage. And that's depleted, and they can't fully meet their spending goals through the end of retirement. And then I'm measuring the shortfall with respect to their spending goals when those points are negative. So with the conventional wisdom, the last resort strategy, it mostly works because they have a conservative spending goal, but there's those 5 years where it didn't work. Now we'll compare that to other reverse mortgage uses. And so this is comparing, what if they use a 10-year payment instead of using the last resort strategy? So they open it at 62 and turn on the 10-year payment and use that to reduce the distribution pressure on their investments, and then pay off the loan balance at the end of retirement. So whenever this line curve here is above zero, the net legacy from 10-year payments is higher. Whenever this line or curve is below zero, the net legacy would be higher with the last resort strategy. And so you can see that about 2/3 to 3/4 of the time, which is consistent with the research from those articles in 2012, the 10-year payment comes out ahead of the last resort strategy. You have a larger net legacy at the end of retirement, net of all the costs of the reverse mortgage. Now, there are cases where the last resort strategy came out ahead a little bit, but those are, as we'll see on the next slide, are just generally going to be cases where markets do pretty well, and so they never had to tap into the reverse mortgage anyway. Now, 1982 it was where the last resort got the best relative outcome. That was a special case where interest rates are incredibly high in 1982, 16%, I think, for the 10-year treasury. And the markets did really well for the first 10 years of their retirement. So they wouldn't have got much out of having the reverse mortgage because interest rates are so high. It just really wasn't necessary. We're not in that kind of scenario right now. But again, most of the time, the 10-year payment's coming out ahead. But this slide lets us see when each comes out ahead relative to how well did markets do in that retirement. And so with this slide, if the points are above the diagonal line, the 10-year payment offers a larger net legacy. If the points are below the diagonal line, the last resort strategy offers a higher legacy. So that point furthest to the right, up near the top right, that would be the 1982 point, where they didn't need the reverse mortgage. Things went great after 1982. They had about a $4.8 million legacy if they didn't use the reverse mortgage. Well, if they use the reverse mortgage, which simply meant paying those upfront costs and getting a small 10-year payment from it, they'd still have a legacy of about $4.5 million. So either way, that's not really a risky scenario. Either way, what we want to focus on is the lower left-hand corner, which is markets don't do so well, and so their retirement is more in jeopardy. And there we can see consistently the 10-year payment, the dots are above the line, so that we do have that risk management strategy. In particular, those 5 dots where going to the left, it's less than zero, that the years they run out of money with the last resort, all 5 of those points, those numbers are above zero. So the 10-year payment allowed them to leave a legacy at the end of retirement after fully meeting their spending goals in those 5 years where they couldn't even meet the full spending goals. with the last resort strategy. So the fact that those dots are generally above the diagonal in the lower left-hand corner reflects the idea that this is a risk management strategy that can lead to those improved outcomes. Now we are getting short on time, but let me just note here that the portfolio coordination strategy I compared to the last resort strategy, and it's a very similar type of story, so that people have flexibility about how they want to approach things. Most of the time, the portfolio coordination strategy comes out ahead, not always. And again, 1982 is the big exception to all this, but not relevant to today because interest rates are not anywhere near 16%. And then there'd be a similar image as well to show the risk management idea is maintained with this portfolio coordination strategy as well. So we are getting low on time. Some other research that I've done, just very briefly, looks at what sort of factors lead to how people want to think about a retirement strategy. And what we focus on is if someone's probability based, they're comfortable relying on market growth. If they're safety first, they want protections behind assets for their essential expenses. If they have an optionality orientation, they want to have flexibility for all their assets. If they have a commitment orientation, they're comfortable committing to strategies that solve for a lifetime need. And we find this framework is really helpful to help as a starting point for retirement strategies. But to just point out that I think this framework can also be used to think about, I talked about many different possible uses of reverse mortgages. And I think different uses might resonate better for different retirement income styles. You've got one strategy I didn't mention, but a total return investor might appreciate is leverage your investment portfolio. Spend from the HECM first, give your portfolio those extra years to grow, and then spend from your investments. If you think the investments will grow faster than the loan balance, also keeping in mind the non-recourse aspects that could be triggered at some point, that might be something to consider. But beyond that, if you want more of a protection-oriented approach, 10-year payment options, building a Social Security delay bridge, just having a liquid contingent reserve fund might all be considerations. So a few key takeaways from all this. Reverse mortgages can't be viewed in isolation. Their costs, which were fully incorporated into this research, we saw it can be more than fully offset by gains elsewhere in the financial plan, that the benefits to the investments well exceed the cost of the reverse mortgage. The conventional last resort strategy hurts retirement sustainability. Strategic HECM use can improve that sustainability and support a larger legacy at the end of retirement. It works because it helps manage sequence risk and because of that idea of the growing line of credit. Now, this is something that's more beneficial to the middle class Americans when their home value is large relative to the size of their investment portfolio. And responsible use of a HECM can really improve retirement outcomes. So it's important for advisors to keep this in mind. It's not for people who run out of money. It's for responsible retirees who want to live in their home and are looking for strategies to maximize the value of their assets in retirement. So let me stop there and invite Betty and Shelley back on for the next steps.
Well, thank you, Wade. Thank you so much for sharing all these different ways. And there's many more things that you can discover in his book about different strategies for how to use a reverse mortgage to secure retirement. So now it's time to address your questions. And we do have a few that came in the meantime. So we'll get started with those. Let's see here. Medical bills, they have become the largest cost for many retirees. Many do not have long-term care. Tell more, if you can explain more about how reverse mortgages can help cover those costs, and even talk about the long-term care premiums too as a way to help pay for some of those.
Yeah, so paying for long-term care insurance premiums. And now if you move to an institutional facility as a single person, you wouldn't be able to tap into the reverse mortgage at that point. But in-home care is that really interesting use. People want to stay in their homes, and having the reverse mortgage as a way to pay for in-home care could be a really attractive consideration. I don't know, Shelley, if you have any further thoughts on that point.
Well, yeah, the reverse mortgage in terms of long-term care, you mentioned policy lapses. If making
Mhm.
contributions to your long-term care insurance over the years. You don't want to give that up, and a reverse mortgage can keep you going. A lot of people don't qualify, and you can just set up the long-term, the reverse mortgage, for long-term care if it's needed. Also, making a contribution to a policy, using a reverse mortgage to kind of pay more so that or pay less per month, pay less per month because you have a longer exclusion period. So there are all kinds of ways, just access to cash helps just about anything.
And then we'll do one more question here. So Shelley, we have enough time for you too. On the 10-year method, does the line of credit grow at all?
Well, if you apply the entire line of credit to the 10-year payments, there isn't a line of credit at that point. But you don't have to worry about it. Even if your 10-year payments would have exceeded the line of credit, they keep coming. You're protected to have those continue as long as you remain eligible for the loan. But I didn't mention it, but it mentioned on the slide modified 10-year payment. You could say use half the line of credit for 10-year payments and leave the other half of the line of credit. And then, the other half of the line of credit would be a growing line of credit that you could tap into. The half of the line of credit you just used for the 10-year payments. That's now out of the picture. But that's in that regard, it's kind of like an annuity as well. It's like the line of credit was your premium to get those 10-year payments for potentially as long as you live.
Yep, very good. All right, Shelley, we're going to turn it over to you to wrap it up with some other ideas.
Yeah, just a couple of who's going to be moving forward the slides, Wade or okay, yeah, just a couple of other things that have been in the news to keep in mind where a reverse mortgage can contribute to challenges in retirement. Seniors are incredibly top heavy in housing wealth. Wall Street Journal last week or the week before wrote that people who are 70 plus own over 30% of home equity. It's north of $15 trillion. So a lot of home equity, and as Wade mentioned, people like to stay at home. So also in the news, there's increasing understanding that seniors are, as they age, start making bad financial decisions. So we can think about a reverse mortgage as an antidote to that. And then also, because home values have ballooned so much, and there have been weather events and all kinds of things going on, the high housing values are contributing to really sky-high property taxes and homeowners insurance. And I was surprised it's not just Florida, Oklahoma, Texas, and Nebraska, I guess, which is the tornado spot there, is making it difficult for people to stay in their homes. So how does a reverse mortgage help? Let's take a look at the next slide. So Wade mentioned several times a 10-year payment. So this is a $1 million house with a 70-year-old. And the amount of money today that person would be eligible for annuitizing his reverse mortgage would be $2,342 a month. So, but I want to take you over to the right-hand side, an amortization schedule, which your loan officer will always be able to produce for you. Again, this $1 million house, the beginning line of credit, if you see the arrow down here at the bottom, the beginning line of credit is $337, and that annuitized into $2,342 a month. But at the end of 10 years at today's interest rates, right where you see that arrow, you can see that the line of credit will have grown to $712,000. So next slide, please. Line of credit, remember, is growing independently of the value of the house. So there you see it large again. At age 70, they would have started with a line of credit at $337, and if they just sat on it, it would have grown to $712,000. So if they had needed the reverse mortgage line of credit in that 10 years, they then, if they wanted to, if they had a need for that stable income coming in every month, they could convert or turn on the 10-year payment, much like a deferred annuity. Next slide, please. So we can actually calculate, if you assume that the line of credit is going to be $712,000, could be less, but there's a very straightforward calculation on the HP 12C that tells you how much the client would be eligible for in terms of a 10-year payment at 10 years down the road, or however many years down they want to convert. So in this example, the $712,000 would convert to almost $6,000 a year, a month, excuse me, $6,000 a month, coming in as that stable income. And then next slide. So a way to, again, just sort of make things more comfortable and stable is to take up a voluntary life expectancy set aside. And what that does is it carves out of that pie that Dr. Pfau described, the whole principal limit. It carves a portion of that out, and the mortgage company will actually use that carve out to make the tax and insurance, property tax and insurance payments for the client. So this is something you can request on behalf of the client, a voluntary life expectancy set aside. Works like an escrow, except it's done, in advance, so that your client doesn't have to worry about making those payments, which can be difficult as they age. So there we are. More to think about.
Very good. Well, thank you everyone so much for being here with us today. And thank you, Wade and Shelley, for your insight and expertise in this area. And proof of CE will be emailed to you to confirm your attendance for those of you who opted in. And we will report your CE directly to the CFP board, and you'll need to self-report for all their professional certification CE. And thank you in advance for completing the session evaluation. So that's it, everyone, for this webinar sponsored by the Mutual of Omaha Mortgage. Shelley, Wade, myself, and the rest of our team, thank you for participating. Have a wonderful rest of your day, and we'll look forward to seeing you again in the near future. Take care.
Thank you, everybody.
Thank you.